Friday, February 13th, 2026. Friday the 13th. Except the only serial killer is this administration, and its victims are the American people. Creator, help us all. Like and subscribe. The $1 Investor. Today we're talking about a controversial perspective circulating about the economy in 2026. The idea that we may already be in a liquidity trap, and that could fundamentally change how markets behave. What is a liquidity trap? Normally, when central banks provide easy money, low interest rates, and liquidity, it encourages borrowing, investment, and growth. But a liquidity trap happens when all that cash sits idle and doesn't stimulate real economic activity. Why it's relevant now? According to the professional economist, financial conditions have deteriorated, with banks holding large unrealized losses and investors waiting on the sidelines. If liquidity isn't doing its job, markets could be more fragile than most expect. The playbook. Rather than simply buy the dip whenever liquidity arrives, their perspective urges us to watch flows of money, credit market health, and where actual investment and demand are headed. Context and takeaway. Some analysts point out that parts of this content might be AI generated, but the broader idea that markets could be transitioning from an era of perpetual liquidity to one of more constrained conditions is something seasoned investors pay close attention to. So the key takeaway? Don't assume easy money will always bail markets out. Watch the fundamentals. Watch the full video of this short on my YouTube channel. And remember, it's never too early to prepare yourself for a conservative administration. They seem to collapse our economies on purpose so they can purchase for pennies on the dollar. And this one is no different. I guarantee this administration will do the same, just as all other previous Republican administrations before them. Now let's get into our video. This video asserts that a liquidity trap is already unfolding heading into 2026, which means excess money supply and low returns on investment are setting the stage for slower growth and tighter financial conditions, contrary to what many investors expect. Liquidity trap in this context refers to a situation where even with loose monetary policy, like low interest rates, economic growth stagnates because banks, corporations, and investors hoard cash instead of deploying it productively. Key points I will highlight. 1. What a liquidity trap is. The economy has lots of cash, but not enough productive investment or demand. Traditional tools like low rates or central bank asset purchases don't boost growth like they used to. Why this matters? In a true liquidity trap, investors can no longer count on easy money creating sustained growth, meaning markets may struggle even if rates stay low. 2. Why this matters for 2026. My opinion suggests liquidity conditions are worsening, real or perceived. Regional banks and financial institutions are under pressure from unrealized losses on loans and securities. Investors may be blindsided because they're accustomed to liquidity-driven rallies. Bottom line, markets may face higher volatility and lower expected returns if liquidity dries up or becomes more constrained. 3. Their exact playbook. Although the professional economists claim to reveal an exact playbook, commentary from financial observers broadly interprets this as a focus on understanding where money actually flows in the economy, watching central bank moves, fiscal policy shifts, and credit conditions, preparing for a different regime than the low-interest, high-liquidity era of the last decade. Translation for my followers. Instead of betting that liquidity will always rescue markets, pay attention to real economic signals, employment, credit growth, earnings, and risk pricing. 4. Important context and skepticism. It's important you know. Some commentary online actually suggests this particular subject itself might be an AI-generated bubble. Regardless of the subject's origin, the ideas about liquidity traps and macro risk are real topics in macro investing. So when sharing, frame the content as insightful market perspective, not financial advice or a literal forecast. Final notes. Liquidity traps historically compress investment returns and lead to greater focus on cash flow and balance sheet strength. If markets indeed shift into such a regime, traditional growth bets and expectations may need adjusting. Remember, I'm not a or your financial advisor. Investing comes with risk, so do your own due diligence. I'm just a random blue-collar bus driver who's found himself the door to the investment world and now knows how to use it. So here's my final thoughts and summary. Pay close attention and listen up. But most importantly, start preparing yourself for the inevitable. What's up, everybody? Today we're breaking down a video that claims we may already be heading into a 2026 liquidity trap. And if that's true, it changes how we invest. Now don't let the fancy terms scare you. This isn't about panic. This is about understanding the environment we're investing in. Because markets don't move on vibes, they move on liquidity. What is a liquidity trap? A liquidity trap is when there's plenty of money in the system. Interest rates are low or falling, but growth still doesn't respond. Why? Because people and institutions stop deploying capital. They hold cash. Banks tighten lending. Businesses hesitate. Money exists, but it's not moving. And when money doesn't move, markets don't expand the same way. Why this matters right now? The argument in the video is that credit conditions are tightening. Banks are still sitting on unrealized losses. Liquidity isn't as powerful as it used to be. We've been conditioned to believe, don't worry, the Fed will step in. But what if liquidity injections don't create the same market reaction anymore? That's the shift they're talking about. Not collapse, regime change. What changes for investors? If we are entering a liquidity-constrained environment, 1. Easy multiple expansion becomes harder. 2. Weak balance sheets get punished. 3. Cash flow matters more than hype. 4. Volatility increases. This isn't the era of just buy anything and wait. This becomes the era of quality, patience, risk management, the playbook takeaway. The real message isn't to panic, it's to watch credit markets, watch liquidity flows, watch where money is actually moving. Because price follows liquidity, and liquidity follows confidence. Real talk closing. Look, markets move in cycles. There are seasons where everything grows, and seasons where discipline wins. If this really is a tighter liquidity cycle, then this is where real investors separate from emotional investors. Stay informed, stay disciplined. Don't assume the last decade repeats itself, because the market doesn't owe us the same conditions forever. Are we entering a 2026 liquidity trap? What is a liquidity trap? High money supply, low rates, weak growth, capital stops moving. Why it's dangerous? Credit tightens, banks reduce lending, investors hold cash. Growth slows. What changes for investors? Quality greater than speculation, cash flow greater than hype. Balance sheets matter. Volatility increases. What to watch? Credit markets, liquidity flows, central bank policy, corporate earnings. The big message. Don't assume easy money always saves the market. Like and subscribe. The $1 Investor.